Hi guys, this is about closing entries. I created a partial ledger which contains only the capital account and the three temporary accounts. The temporary accounts being the withdrawals account, the fees earned, and the expense accounts. I also created this temporary account called income summary, which is brought on in the closing process. Now, there are four closing entries. I'm going to perform them right in these accounts. I'm not going to journalize them for the sake of time. The purpose of the closing entries is to transfer the net income or loss for the period into the capital account, and at the same time, uh, we update the capital account and bring these accounts to zero in order so that they can accumulate the next period's activities. We also debit out the withdrawals account as well to show the reduction of withdrawals on the owner's equity account. So let's go. Anyway, this beginning balance has been here all year long, all period long. So the first thing we want to do is close out the revenue accounts. And the revenue obviously has a credit balance of 80,000, and in order to close a credit balance, you have to debit it. So closing entry number one is to take that 80,000. I can label it number one. Okay, so there is closing entry number one, debit fees earned. What I do is I transfer it. I transfer it into the income summary account with a credit of $80,000, and that gives the $80,000 gives the income summary account an $80,000 balance. Okay, so that's closing entry number one, debit fees earned, credit income summary, which closes out the fees earned account. As you can see, the credit of 80 is debited out, bringing it to a zero balance, which we can put in there. And then to take the expense accounts, which you can see are $30,000, we want to debit those into the income summary account. So typically we'll make a compound entry taking the sum of the expenses, which is $30,000, as you can see. Note this would be the total of the total debits column in your income statement columns of your worksheet. So what you do is when you close, you take those total debits and you debit them to the income summary, and then you have to take each of the expense accounts and enter credits into those accounts in order to close them out. So there's the $20,000 credit to the selling expense account, which leaves it with a zero balance. And then also actually this is number two, sorry. Okay, so we get that squared away. So there's $20,000 credited to the selling expense account, leaving it with a zero balance. I've got a debit in the office expense account, which needs to be credited. Closing entry number two. Okay, $10,000. Dun, 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 dun. Okay, so you got a debit of 10 as a balance and a credit which wipes it out. So there's a zero balance there. So now you've got the both the revenues and the expense accounts are closed, and you can see one and two. The second entry created a profit if you've got a 30 as a revenue and you got 30 as a revenue and a 80 as a revenue and 30 as an expense, you've got 50, which is the balance in that account at that point, which is the amount of the net income. I suppose for teaching purposes, I could label that $50,000 the net income. Hopefully it'll fit in there, and there it is. Okay, so hopefully we'll be good. All right, so again, typically you would not do that in an account, but you can see the revenues minus the expenses equals the net income. Now the third thing to do is to take that credit balance and debit it out of there. and you want to transfer it by debiting it out of there. You want to take that income of $50,000, put a debit in the income summary account, closing entry number 3, and finally, Mr. Doe up here is going to reflect the increase in his balance by the amount of the net income for the period, which is $50,000. And of course, that doesn't go in that column. It goes right over here. So number 3, again, we credit the capital account for $50,000. Okay, so temporarily we've got a $70,000 balance in there. Okay, so closing 1, put the revenues in the summary. Closing 2, put the expenses in the summary, creating a summary credit balance of 50, which I'm labeling the net income. And then closing number 3, we debit the summary for 50, which kills that 50. So you can see that summary account is in and out in the closing process. Fourth and finally, it would be to take the amount of the withdrawals, which has been recorded temporarily in the withdrawals account. If it has a debit balance, we have to credit it, but where does it go? It goes to the capital account. So the fourth and final closing entry then takes that $15,000 and debits it to the capital account, which brings the capital balance down to 55. All right, and then we, of course, have to come into the capital account. That's closing entry number 4. So we pop a 4 in there. A debit balance is closed with a credit, as you can see, and that brings that debit balance down to 0. So why that came up as red, I don't know, but that's fine. So there's nothing in the withdrawals account. Temporary accounts are closed. What are the temps? They are the withdrawals account. Otherwise, this would go right into capital, but we accumulate. Same thing with revenues. They could go right into capital, but we need to prepare an income statement, so we keep the revenues in their own separate accounts. Same with the expenses. We keep them in their own unique accounts temporarily. And then at the end of the period, the impact of revenues and expenses, which you know is, in this case, a profit, is finally transferred into the capital account right there with closing entry number 3, and then closing entry number 4 finalizes the closing process that brings John Doe down to 55. So he had a nice increase, didn't he? He went from 20 at the beginning to 55, an increase in owner's equity of $35,000 for the period. The end result, we've accomplished our goal, which was to zero out all the temporary accounts and to update the owner's equity, the purpose of closing entries, to clear out the temporary accounts, 0, 0, 0, 0, get them ready for the new period so they can start accumulating the next period's activity, and then to update capital. And you know that $55,000 is going to be the amount that's going to be shown on the statement of owner's equity. I can just briefly show you down here. If you had a beginning balance of $20,000 in the owner's equity account and you add $50,000 of profit, you could get a subtotal if you wanted, which you can see right in the account. But I'll just take out the 15. And if I take the 15 out, what do you know? You know that the balance, the ending owner's equity balance, would be, in fact, the same amount, $55,000, which is in the capital account itself. So your owner's equity, this $55,000 would show up in 2 places. It would show up in the owner's equity, O/E account, statement rather, and it would show up as the ending owner's equity in the balance sheet. Okay? Done. Okay, 4 closing entries. Purpose, clear the temps, update capital. Done.